So anyway,
Well,
thank you guys so much for being here. This is TMC Connect. We have an exciting conversation about benchmarking. We're going to look at 2020 as well as forward to 2021. We've got Britt Haven and John Sayer with us from FBX Informa, and they're going to be giving us some information and statistics. So thank you all for being here. I'm going to tell you that we are recording. You will get a follow-up email and a link to the recording tomorrow. So very much appreciate it. I'm Tony Bramley. I'm the Business Development Coordinator at TMC. And with that, I'm going to turn it over to Britt and let her introduce she and John.
awesome. Thanks so much. Good afternoon, everyone. Appreciate you all taking some time to join us today. I see some familiar names on the list. So, but for those of you that we don't know, my name is Britt Haven. I am the Sales Director of Lending Solutions, part of the mortgage team here at Informa FBX. I've been with the company for a little over a year, been in the industry for a little over 10 years, kind of on the vendor side, unless you want to count my college internship at New Century Mortgage as an experience on the lender side. But I'll be kind of going through the first half of the slides today, and then John Sayer, who is our VP of Client Success, will be running the second half. John's been in the mortgage industry for over 30 years. Prior to joining Informa FBX, he's run capital markets for several large lenders. So he sat in y'all's shoes and actually used our data. John, do you want to hit to the next slide? And then we'll be leading the bulk of the webinar. However, we might have a few guest appearances from our counterparts, Paisley and Gunnar. They tend to like to chime in from time to time. So if you hear them in the background, that's just them saying hi. All right. And so today we're going to be looking at some data from 2020, kind of some highlights of what happened in the mortgage market in 2020 and how to prepare for the changing market in 2021. So I'm going to spend a few minutes here going over some key understandings from 2020. You know, there's a lot that happened aside from just historical volume. And then John's going to kind of correlate that to how to apply those learnings and best practices into 2021. The next one. Great. Before we jump in, just a little bit about the data that we're going to be going over, kind of how we get our data, where it comes from. All the data is lender sourced. Our lenders, part of the consortium, they provide weekly app lock and funding data. It makes up about 55, a little bit more of retail mortgage originations. And it's a combination of national and regional banks, independent mortgage bankers, and credit unions. Again, it's all lender sourced, makes up over 55% of the retail market. We do have correspondent and wholesale as well, but we're going to be focusing on retail for today's call. But what that means is that it's a statistically significant amount of data, again, real time, over 55%, and it allows our clients to use the benchmark to better understand market share, operational efficiencies, business mix, pricing competitiveness, which we'll talk about some today in this call. So real quick, kind of a 2020 in review, just overall. This is the totals for retail. And again, it's based on our data. So it's, about 55% or so of the retail originations. In 2020, we tracked a little over 1.1 trillion in retail fundings. Overall, including wholesale and correspondent, it was roughly about 2 trillion. That's about a 68% year-over-year growth on the retail side. Breaking it down, about 65% branch business, 35% call center. You'll see call center was up by 138%, pretty significant, 3 times the branch volume. You also see the lender type, about 45% financial institutions, 55% mortgage bankers. So you'll see IMBs really, they grew by about 112%, which also kind of correlates to the decentralized or the centralized, growth as well. And part of that too is their velocity, their ability to close loans is a little bit faster than overall on average on banks. So again, kind of where they're picking up that market share. No surprise that refis rate and terms are up by 180%, but stayed about or it's about 51%. So there was still 36% purchase, which was up by about 14%, and then cash out refis were up by about 26%. So obviously, this is the whole year, depending on how you cut it and where you looked. The liquidity crisis in March had a big impact on the market, but the business mix kind of shifted back towards more normalcy as the year went on, and then obviously everyone's enjoying historical margins. So again, that's a high-level overview of 2020 from a national standpoint. The next slide is going to be just West Coast. So West Coast is Texas, or sorry, I keep saying West Coast, but Western U.S. So that's the West, Texas over, Texas West. All the states that we included are listed up at the top. So again, from our database, which again makes up about 55% of the retail market, the West Coast was at about 552 billion for funded volume, to about 77%, so a little bit higher than the average for the country. Centralized or decentralized branch was at 70, centralized was at 30, so there's a little bit heavier shift towards the branch than the call centers, but again, call centers were up by 148%. So again, still close in line with the national averages. A little higher on the mortgage banking side, but then pretty similar to the national averages for purchase and refi and cash out volume. We'll go into this in a little bit more. No surprise, California had the largest volume over the year, but surprisingly, it was on the low end for growth. Alaska actually grew by about 108% year over year. And again, we'll talk a little bit more as we get through some of these other slides. So shifting gears, we're going to take a look at refi turn times. We've broken it out into conforming, government, and non-conforming. And we're just focusing on refi business because that really is, when it comes to turn times, the variable component. You have a little less control over purchases, but refis, you can. This is overall for the entire country, a look over the last, rolling 13 months. You'll see that cycle times for conforming business, conforming refis, they were at, kind of in the mid, low 60s to start the year off, dipped down pretty low in March, again, because of the economic and liquidity issues and everything. And then obviously continued to grow up and kind of stood around 75 days. It's been kind of the average for the last few months. And again, this is kind of the overall for the country. Looking at the last 6 months of the year, the average turn time was about 71 days. For the West Coast, it was about 70 days. So the West Coast was actually funding conforming loans a little bit faster than the average for the second half of the year. And again, I kind of looking at the second half to take out that big dip that we saw in March. Utah was, for the second half of the year, was the shortest turn times, 61 days. Arizona was close behind it at 63, and then Idaho, Kansas, and Nevada were 65 days. So those are kind of the top five. Slowest turn times in the West Coast were North Dakota was the slowest at 84 days, and then Alaska was 83, Hawaii 81. Overall fastest in the U.S. was Utah at 61 days, so the West Coast was the fastest. Slowest was about 99 days in New York. So again, this is just conforming refi business from our benchmark, which again is about 55% of retail originations. Then looking at government refis for retail, you'll see, similar trends, but obviously about 20 days faster than conventionals. The average for the last 6 months was about 54 days. The West Coast was a little bit higher on the government side at 58 days. For government refis, over the last 6 months, Montana was the fastest at 46 days. Nebraska was right behind it Nebraska, and Kansas were right behind it at about 49 days. Slowest were New Mexico at 79 days. The overall fastest app to fund times across the U.S. for government loans were Tennessee, Arkansas, and Montana were tied at 46 days, and then the slowest was New York at 80. Then the last month, so the first month of 2021, average Gov turn times are about 55 days, so slightly higher than the last 6 months, but only by a day. And the fastest was Wisconsin coming in at 36 days, and slowest was Alaska coming in at 101 days. So if we're going to take a look at non-conforming, no surprise here. Obviously, non-conforming has a little bit higher, longer turn time averages across the country. Averaging in around 90 days across the country. For the last 6 months, averaging about 95 days across the U.S. Just for the West Coast, they averaged about 100 days for non-conforming. The fastest on the West Coast were, or the west side of the country, were Kansas and South Dakota at 76 days. Slowest was Nebraska at 198 days. And then looking at kind of the last 4 weeks, again, the first month of 2021, turn times were actually across the country for non-conforming were down a little bit, 89 days. However, the West was actually up to 102 days. But that probably has something to do with Nebraska having a turn time of 304 days on average for non-conforming. So again, slight shift over the last month, but overall, kind of hovering at that 90, around 90 plus days for non-conforming. And again, no surprise there. So then jumping into some kind of business mix, looking at what products were originated in 2020. Again, this is looking at the whole country's volume. You'll see that no surprise that obviously the conforming 30-year was the largest product. However, its growth was 82%, which is pretty good. I mean, wouldn't complain about that, but you'll notice that the conforming 15-year, agency jumbo 30, VA Earl conforming 20, VA jumbo 30-year were all up by over 100%. The VA Earl 30-year was almost 287, almost 300%. So those products really grew significantally this past year. And again, no surprise that the conforming 15-year grew as much, with rates being as low as they were. And then obviously the non-conforming products did not grow nearly as much. And again, due to some of the economic and liquidity issues beginning of the year, and people kind of pulling out of doing some of that non-conforming business. And then last slide I'm going to cover before I hand it over to John. This is looking at specifically the western states of the U.S., their overall volume by state, and looking at it compared to the prior year. So again, some of the biggest growth states were Utah, Oklahoma, North Dakota, all growing by 90+%. California, though its volume was the largest, almost $500 million just in California and again, this is all retail funded. It only grew by 53%. And again, that's probably a result of a lot of lenders pulling back on jumbo lending and such. But again, a lot of growth in in some of those other states, again, almost by 90%. So again, this is just kind of a high level recap of what's happened, what happened in 2020. Once we're off this call, if any of you would like to get a copy of the deck or like any additional information on any of the other states or something in more detail, please reach out to either myself or John, and we'll be happy to get that to you. And with that, I'm going to hand it over to John to walk through, kind of how to prepare for 2021 and how we can leverage some of this data to do that.
And John, this is Tony. Before you get started, just a reminder, if you've got any questions, please drop them in the chat or the Q&A. I can voice those for you or raise your hand and I can unmute you and you can ask those questions to John or Britt. Britt, I did have a question. Given the March economic event, how did the average credit scores trend for the balance of the year?
Great question. John, I think you might have a little bit more, you might have some more data, so I'll let you get to that.
Yeah, I appreciate that. Yeah, so as you saw, the production changed dramatically there in March. We had some credit score cliffs, if you will, where, less than 640, less than 680 became non-existent. Some lenders, though, were a little bit slow to the party, and we certainly saw some folks sticking out for a period of time until they normalized to the market. But the good news, as we've seen in the non-QM market and other markets, that things loosened up a bit. So certainly we saw a recovery into some of the lower credit scores, but there were still some pretty hard cuts where you don't see much at all, if any, under 620 for conforming and governments as well. And certainly in the jumbo side of things, the best credits just getting processed, really people focusing on the easy to do loans and not so much on the hard to do loans. But we did see the credit trends loosen up a bit towards the second half of the year.
Thank you.
Sure. All right. Well, Britt, thanks for sharing some of the highlights for 2020. Certainly a landmark year. I don't think like any other that we've experienced, at least in my, as you said, 35 years of what I've seen, like no other in lots of different ways. Certainly the market growth across the states, the products, and the loan purposes has been extraordinary. But what we're looking to do here is take some of what we learned in the last year and apply that to 2020. And as we know, as we've seen, as I've seen through many business cycles since I started in 1986, three main things can happen. Volumes can kind of stay where they are, or rates can go down, and we can get even. Maybe we see 1% increase, 1% loans. Who knows? Or rates can come up a bit, and then the rate and term refinances could drive down a bit. We saw about half the market is rate and term refinances from what Britt showed, so we need to plan for those eventualities. But other than just at a macro level, thinking about that this or that could change, thinking more in terms of best practices to get ahead of that and to react to it in near real time, and what we would put on the table. We deal with probably 70 of the top 100 lenders in the country in all sorts of different ways, and have some visibility, I think, into best practices and things that we've seen that may be useful for you all to hear, the TMC members to hear today. I would say, and put it near the top of the list, establishing metrics, whatever those metrics are. If it's 5 different metrics, 10 different metrics, whatever it is, as a company, you're looking at those data points, whether it's every week or every month, and really seeing what's changed period over period. Where are things sticking out, and how ought we respond to that? Best practice, again, would be to involve all stakeholders. So secondary and production have the same lens into the market. And I think, there's oftentimes a push-pull on the secondary versus production side. At least in normal markets, maybe not so much last year, but normal markets. And I think a lot of that can be mitigated by folks having a common lens into the market and how the company's actually performing. The risk side, operations as well, and I'll get into some cases around that. Operations. So thinking about your value proposition to the market, obviously price is one of your value points, but this last year has really been, a lot of it's been around process. Even though it's taking longer than normal to get loans pushed through, think of the historic efforts that have happened this year to get borrowers into lower interest rates and get their loans closed on time for purchase transactions. But if you or one of those lenders that Britt was sharing with us earlier that has gone from 40 to 50 to 60 to 70 or higher number of days for your refinances, I think it's important to have that number as a relative number relative to others and really understand across different products, whether it's Govy loans, conventional or jumbo, how are your cycle times responding relative to others, and tracking that in the market. And I think a lot of that can be applied towards if you're one of those that are doing better than the market, it's certainly a recruitment and retention tool for loan officers. And yes, they're getting loans pushed through is slower, but not as slow as others. And having that understanding on your operations, I think, is significant. The other thing I'll mention, my background is primarily secondary marketing. Used to hedge positions and put, pull through numbers in for hedge ratios and all that. But even if I got those ratios perfect, if I was pulling through less than other lenders, that's an operational issue, and therefore the need to have that as an operational metric, operational pull through. Obviously, if you're able to, if you're running 70% pull through and the benchmark, others are running 80%, that raises your costs of origination. From a market share standpoint, and I steal this one from Britt, when she joined us about a year ago, she basically said, well, what you do at Informa boils down to, it's like a football game. The Buccaneers, if they score 24 points in the Super Bowl game, is that good or bad? And the answer is, well, if they score more than, if the Chiefs score 20 points, it's great. If the Chiefs scored 35 points, it's not so great. So really understanding, even though your volume may have been up 50% last year, or in a normal year, maybe 10%, what have you, is that good or bad? Your volume perhaps in January, maybe it's down 20%. Well, if the benchmark, if other lenders are down 30%, you actually gain share. And having that visibility for production and secondary, I think is critical for lenders to have those, make good conversations around their pricing and so forth. It's really about transparency into performance and really getting production and secondary on the same page, and having those market share metrics, wherever you get them from, I think is super critical. Business mix. When Britt put up on the list there, hey, conforming was up, conventional 30-year conforming was up, whatever it was, 34%, and IRRRLs were up 300%, and all those different increases from last year. It makes me think of, if you probably sell 5 products, year in, year out. And if you were a retail store and you sold 5 products, your objective wouldn't be to sell more of one at the expense of the other. It wouldn't be a zero-sum game. You'd want to sell more of everything, or at least optimize your market opportunity in any given year. So the idea here is really to drill down into product level and understanding your share of market for each product, to make sure you're not really thinking things as a zero-sum game. And that, of course, would go for this year, this coming year, if rates do back up a bit and the purchase market becomes hyper competitive, how are you monitoring your share of the purchase market? How are you validating that if year over year we saw purchases were up 14% in the benchmark, are you protecting your share of market in the purchase side of things? Obviously, high balance loans for the coasts is really important to monitor. But I would say one of the things that is really impressed upon me here in working with lenders as we do closely is really understanding their business mix across different loan attributes. So for portfolio lenders, for those of you that may retain some loans in the portfolio, understand your risk mix across loan attributes. Certainly for government lenders, you want to be aware of your neighborhood watch score and where your credit scores are falling out relative to other lenders. Price position. I would say the biggest story last year, or the biggest conversation we had with lenders, was around those cycle times on refinances. And the parallel conversation was around refinance pricing. We saw some lenders, and I have this, you ought to know when, we saw large national lenders dialing back their refinance pricing 1, 2, 3 points. And I think it's really important for your organization, even if you choose not to do such a thing, to understand that major market players are dialing back their refinances significantly, their refinance pricing, for obvious reasons. And we did see a significant migration of market share just for this whole topic here around refinances. So clarity in understanding of price position across purchases versus refinances, and then an awareness as to where others are basically filled up and getting out of the market. Sticker price versus actual locks. You know, there's the concession activity that happens in normal markets, less so last year, obviously. But what I would share is just in the conversation we're having with a good number of lenders, because we track concession behavior as well among our clients, is really understanding and shining a light on concession behavior at the loan officer level. Obviously, there's a lot of different business models out there in terms of price authority, and our opinion and conversations we've had is there can be drastic differences loan officer to loan officer in terms of their concession activity. And that has major implications to our next topic, which is margin management and having insights into that part of the business. If I were to say, if I knew then what I know now, the margin management function, I think for many lenders is underappreciated. Personally, I spent in secondary marketing the predominant amount of my time, far majority of my time on the sell side, the best sex side. Where could I sell loans in the secondary market? How can I get the lowest guarantee fees from Fannie Freddie, doing buy-ups and buy-downs, specified pools, all the wonderful things that you would do on the secondary marketing side to optimize your sales. Much less time on the buy side. And there is a argument to be made for many lenders, and many lenders are in this camp, where those functions are completely separate, where the buy side is managed separately from the sell side. The buy side, of course, is where you're pricing loans into the market. We do see lenders with great margin variability by loan attributes, whether that's loan amount, whether it's credit score on government loans, whether it's portfolio loans. We do see a lot of variability. Purchase versus refinance being the best example last year. And the function here and the understanding is that the secondary market price isn't necessarily correlated to the buy side side of the equation, where loans are being originated, where margins are being set. And that margin management function, as it sits today, can reside in the corporate side and also in the regionals with regional production folks, and certainly even at the loan officer lender level, where people are making concession decisions all day long. So really that what we're seeing in terms of best practice, and it will come into play this year if margins start compressing. What metrics do you have in place to monitor margins, other than the fact that you heard from a loan officer that they lost a deal? You know, what sources do you have? What data sources do you have, regardless of what they are, for you to be able to know in real time that margins are under pressure? So takeaways. Britt mentioned our dogs earlier. Our chief operating officer ate the takeaways, and I think, Britt, that the chief risk officer, your dog Gunner, ate your lunch today. So we close the loop on that, but I do actually have some takeaways. So really just four thoughts, and please shoot any questions while we go through this if anybody wants to have us dig deeper in the data or what have you, or talk about last year or this year. Transparency into the market enables, you know, informed view and good decision making. You know, data-driven decisions. You know, that is the direction we are all going in. Data and in a contracting market, if we do end up in the contracting market, data will guide you best potentially in making good decisions around your business. I really do think regular business reviews to see period over period, okay, these are the metrics that we set, whether it's market share, whether it's business mix, whether it's the operational cycle times, whether it's your price position, being able to see across your markets, across your products, across loan attributes, where are you sticking out, what changed, and how ought you as a cross-functional team address those changes. And then just that proactive, you know, what are we going to do if this happens? What are we going to do if that happens, as opposed to reacting to what did happen? You know, we have this rearview mirror for 2020, hopefully 2021, looking forward out through the future, anticipating those different business environments and leveraging your data sources, whatever those might be, to optimize that. I know our good friends at TMC have invested considerably into benchmarking for many of your operational you know, details, costs to originate and so forth, and that's fantastic. Think of us as the next step in that continuum in terms of what we do. As Britt mentioned, we track about 55% of all originations across the country, and we've been doing this benchmarking for, you know, a couple decades. So appreciate your attention. Hopefully some good data that you may have learned to think how to put your performance in context in 2020, and just a couple thoughts for 2021.
Excellent. Thanks, John. Thanks, Britt. I do have a couple of more questions, but wanted to let the audience know if you've got any questions, please type those into the chat, and we will take those as you type them in. One question, John, so with the purchase data we saw, you know, across the country, it was 14% was the increase, but did that happen with both government and conventional loans?
Yeah, we saw, and I'll just flip back to some of those slides. So as you mentioned, we saw very considerable, well, for national, we saw purchase up 14%, and then rate and term, you know, up, and even cash out up much more than obviously purchase. But that didn't happen equally among the different products. So when we go down looking at the amount of growth that we saw, for example, in VA IRRRLs, and we saw that in FHA refinances as well, the growth on the Govy side was considerably a refinance story. Purchase governments basically held serve year over year. We were about flat year over year on government purchases. And then for conforming, we saw a really nice lift in conforming purchases, and for conforming refinances, obviously, but not as much growth as we saw in government on refinances for conventional. And then jumbo was just jumbo, hard to do. And a lot of this is really driven around how can you get loans through the pipe, right? Where you're going to go to what's easiest to do, and purchase transactions for conventional, easier to do than govies. Refinance govies, super easy to do with the reduced documentation. And non-conforming loans, as we saw, we even hate to tell you what numbers.
Nebraska.
Great. On the jumbo side for refinances in New York, I mean, some lenders are running 120, 130 days to get a jumbo loan through on a refinance. So, yeah, that's the story.
Yeah, makes sense. Thank you. And then you mentioned that some lenders, they're leveraging the data almost as a best in class. What are some examples of using that data to make it actionable?
Sure. So when we think about, I'd give that example of, hey, volume was down 20%. Is that good or bad? It'd be good. You don't know.
Right.
Corollary to that, I can think back in my experience where, as a organization, we say, hey, we're going to run a purchase special. We're going to do it in this state for a month. We're going to knock a point off, and I'm sitting around the table, and there's the CFO over there, and there's the CEO, and there's the head of production. And the CFO puts up his hands, and we're just going to give away margin, aren't we? And we all look around, and we're like, oh, I don't know. Maybe, I'm not sure, but we're going to run a purchase special, right? So we run a purchase special, and volume's up 10%. It's like, okay, great. But was that attributable to what we did? And a good business case example that we had with one of our clients here, they did a margin reduction last summer, and it was an across the board margin reduction. And they calculated that given that margin reduction, they would have to do 10% more business to be revenue neutral, and which is great. So they made the change. We looked at their market share before the change, then we looked at it after the change, and their volume went up 25%, which sounds really good. And then we looked at, well, they're up 25, but what was the benchmark up? Well, the benchmark was up 10%. So they were able to see, hey, look, I outpaced the benchmark, everybody else, by 15%, right? And my revenue break-even hurdle was a 10% increase. So I actually overperformed. So you can look across the table at the CFO and say, guess what? Not only were we revenue neutral, we actually gained revenue on that price, that margin move, and we got 15% more volume than we otherwise would have gotten if we hadn't made the price move. So now production is happy, finance is happy, and so on and so forth. So a really good example of trying to take whatever the source, data source, being able to benchmark what you're doing, holding people accountable. So if we do go in and say we're going to make a margin move or do a policy change around concessions or whatever it is, being able to hold people accountable for the performance after you made that change.
Makes sense. Qualifying and quantifying using benchmarking. Love it. Yes, and TMC does believe very much in benchmarking. We do have a TMC benchmark for those who want to compare themselves to other members of TMC. One of the platforms that we have also is Ask TMC. So if you've got questions, you can come back to that platform as well. And thank you, John. Thank you, Britt, very much for all of the information that you've shared with us. If you guys were not able to join the eastern part of the country call a little earlier today, it will be available on the TMC YouTube page, or you can reach out to Britt and John for additional information. This platform that we're on right now is TMC Connect. Please come to TMC's website and check our member events calendar. We've got lots and lots of sessions for you. Next week, we've got a session on IRLA. We've also got a session on the DC pendulum shift and how the Democrats run government will affect banks and independent mortgage bankers, independent mortgage companies. So anyway, come back to TMC Connect. We very much appreciate it. And Britt and John, once again, thank you guys very much for your expertise today. Give them a call if you need anything.
Thanks so much.
Appreciate it.
Yeah.
Y'all be safe.